Hey everyone, and welcome to this explainer. Today, we're going to completely reframe how you look at your money. I want you to step out of the mindset of being just a consumer or an employee and step right into the role of CEO, the CEO of your own life. Because think about it, just like a corporation has to finance its buildings, its equipment, and its operations, you have to finance your life and your standard of living. Mastering your finances really means understanding the economic machine, and more importantly, figuring out how to capture the cash flowing through it.
You know, the economist Adam Smith actually nailed the fundamental challenge of this role centuries ago. He wrote, "Money, says the proverb, makes money. When you have got a little, it is often easy to get more. The great difficulty is to get that little." That quote perfectly captures what personal finance is all about, right? It's the strategic process of tackling that great difficulty, learning how to get what you want, building productive assets, and ruthlessly protecting what you've got.
So, here's our roadmap for today. We'll start with income, expenses, and budgets. Then, we'll look at assets, debt, and equity. After that, tracking your finances, and we'll wrap things up with the bottom line.
All right, let's dive right into part one: income, expenses, and budgets. When you break it down, in a market economy, your revenue streams really come down to two fundamental paths. You're either selling your labor or you're selling your capital. When you trade your time and skills in the job market, you're usually starting out in a buyer's market. That means employers hold the leverage. But as you compound your skills and expertise over time, you transition into a seller's market where you can command a premium for your time. Now, the alternative is selling capital. This is where you deploy your excess cash to people or companies who need it. Because businesses have an absolutely insatiable appetite for capital, this exists as a perpetual seller's market, giving investors a massive structural advantage.
So what happens when your spending outpaces your earnings? Well, you hit a budget deficit, and that leaves you with three pretty unsustainable choices. You either consume less, try to sell more of your labor, or borrow. And we all know borrowing merely delays the pain, right? It just inflates your future expenses with interest. On the flip side, operating at a budget surplus, that gives you strategic freedom. You can increase your consumption, buy back your own time by working less, or, crucially, deploy that extra cash to save and invest, compounding your future wealth.
Let's move right along to part two: assets, debt, and equity.
Now, we all love buying stuff, but an actual asset, it has to pull its weight. Functionally, it must perform at least one of three crucial roles. It needs to reduce your future living expenses, generate new income, or act as a secure store of wealth. Take a car, for example. It might reduce your commuting expenses compared to constantly taking ride shares, but it generally depreciates. A home, that reduces your rent expense and acts as a store of wealth if the market goes up. But investments in equities or bonds, those are your absolute heavy lifters for both generating income and storing wealth. The holy grail of assets in your portfolio is one that does all three. But hey, acquiring those assets requires capital, which introduces some hidden expenses we need to talk about. The first is opportunity cost. It's the reality that choosing to pay for an expensive professional masterclass means sacrificing the money you could have used for a vacation. Literally every allocation of capital has an opportunity cost. The second hidden drain is the psychological trap of sunk costs. These are funds that are already gone. They've been spent and cannot be recovered. As the CEO of your life, you have to manage future cash flows, not past regrets, no matter how much you wish you could refund that impulsive tech purchase you made last year.
So how do you actually finance this personal empire? You basically have to choose between equity and debt. Equity means you exchange a share of ownership for capital. This dilutes your future gains because you have to share the upside, but you also share the downside risk. Debt, on the other hand, lets you keep all the upside of an asset, but it forces you to rent capital at a strict premium, which is interest. It's a total high-wire act of risk versus reward. Used strategically, debt accelerates how fast you can acquire assets, but you are strictly on the hook to return the principal plus the cost of renting it.
Okay, let's bring these concepts down to earth in part 3, tracking your finances.
Before we open the books, let's just get our methodology straight. Massive corporations use accrual accounting, meaning they record economic events regardless of immediate cash flow. But the business of you, that relies on straightforward cash accounting. We only recognize and track transactions when the physical exchange of money actually hits the ledger. It gives us a highly grounded, totally unforgiving view of your personal liquidity. Let's look at a real example. Meet Alice. Today, we're stepping in as her ruthless internal auditors. Alice earns gross wages of $44,650 a year. She pays her taxes, covers her rent, and handles standard living expenses. On the financing side, Alice previously used debt to acquire two assets, a car and a college education, so she has active auto and student loans. Let's translate all of this into her official financial statements.
We'll kick things off with Alice's income statement, which summarizes her earnings against her cost of living. After taxes, she nets a disposable income of $35,720. But watch how rapidly everyday life just eats up that capital. Rent, food, car maintenance, clothing. Her total living expenses drain over $25,000 right off the top. Then we have to account for her debt. Now, on an income statement, we only deduct the interest portion of her loans, because interest is the actual operational expense of renting that capital. Her loan interest aggressively drains another $4,480.
So after all those operational expenses, Alice is left with a net income of $6,040. On paper, CEO Alice is absolutely crushing it. She's running a really healthy surplus. If we close the books right here, we're popping the champagne.
But here's the catch. The income statement is kind of lying to us. Welcome to Alice's cash flow statement. This tracks the literal cash bleeding in and out of her checking account. Remember those loans? Repaying the principal amount of a loan isn't considered an expense on an income statement because technically she's just returning borrowed capital. But it absolutely requires hard cash leaving her wallet every month. Factoring in those financing cash flows, she spends $5,640 just repaying the principal on her car and student loans. That slashes her actual free cash down to a painful $400 for the entire year. Her liquidity is practically zero. This is why you absolutely must track both net income and cash flow to truly diagnose your financial health.
Which brings us to our final section. Part 4, the bottom line.
Listen, the ultimate defense strategy for your personal balance sheet is diversification. It's all about insulating yourself from single-point failures in the labor market. If you rely on just a single employer, you're carrying immense exposure. You can mitigate this by diversifying your income streams, sure, but the true executive move is selling both labor and capital. Operating in the job market while simultaneously holding a balanced portfolio of equities or high-yield accounts. That means you're trading in entirely different economic spheres. If demand for your labor dries up, your capital investments are there as a vital safety net, ensuring one bad economic cycle doesn't bankrupt your whole life.
Because at the end of the day, every transaction, every asset, and every debt dictates your personal bottom line. The data is all right there on the table. So I'll leave you with this. Are you running a surplus or a deficit? You are the CEO of your life. How are you going to manage the business of you?